A buyer's ability to finance property is a critical factor in most residential real estate transactions. Some buyers may have the ability to pay cash for a property, but that's not the norm. For most buyers, they'll need to obtain a mortgage. Mortgages are secured, fully amortized loans. A fully amortized loan is paid back over the term of the loan through a specific number of payments and amounts. Mortgage loans are also secured loans, which means the borrower offers up some sort of collateral to the lender as a way of ensuring that the loan is repaid. Standard mortgages are the most common way to finance real estate. However, there are other kinds of mortgages with their own advantages and limitations. We'll discuss 3 other common types of mortgages: second mortgages, wraparound mortgages, and chattel mortgages. Second mortgages are any mortgage loan that's secured by a property that already secures another mortgage and tend to have much higher interest rates than standard mortgages. The lien established by a second mortgage is second in line to the lien established by the first mortgage loan. This means if the borrower defaults on either mortgage loan, the holder of the first mortgage is the first to claim any proceeds from the sale of the property after foreclosure. If the holder of the first mortgage is satisfied and there's money left over, the second mortgage holder will receive money to pay off the remaining debt from that mortgage. However, there is a risk that the holder of the second mortgage won't receive any money if the sale proceeds aren't sufficient to cover the debt. There are 2 specific types of second mortgages commonly issued: home equity loans and home equity lines of credit. Home equity loans are standard lump sum loans that convert the equity of a house into usable funds. Home equity lines of credit operate on the same principles as home equity loans in that the equity is effectively converted into usable funds. The difference is that home equity lines of credit operate more like credit cards, and the borrower is allowed to borrow against the equity whenever they wish. What homeowners need to keep in mind when considering taking out a second mortgage is that it places an additional lien on the property and decreases their equity. A wraparound mortgage is an alternative method of financing real estate that's commonly set up between buyer and seller without the direct involvement of a lending institution, although in some rare cases they can be established by a lending institution. Wraparound mortgages also generally have higher interest rates than standard mortgages. A property owner looking to sell a property on which they currently are paying off a mortgage will establish a promissory note with the buyer and then complete the transfer of ownership with the property. From then on, the new owner of the property makes a periodic mortgage payment to the former owner. The former owner continues to make periodic mortgage payments on the original mortgage loan and keeps any extra money from the new owner's payment as profit. In effect, the mortgage established between the buyer and seller is used to pay off the original mortgage on the property and provide the seller with some extra profit. Wraparound mortgages can have advantages for sellers who are having difficulty selling a property or for buyers who are having trouble finding financing from lending institutions. But this type of mortgage can be fairly complicated through the assumption of the mortgage and the escrow process. This is why wraparound mortgages are used in specific situations only. Finally, a chattel mortgage is a mortgage loan secured by some form of personal property not tied to a piece of land. Like a standard mortgage loan, the borrower transfers ownership of a piece of personal property to the lender until the loan is paid off. If the borrower defaults on the loan, the lender takes full possession of the personal property and then sells it to recover losses. The most common form of a chattel loan in real estate is for the purchase of a manufactured home not being sold with the land it sits on. Since the manufactured home is not connected to the land, it acts as the movable property pledged as security for the loan. Taking on a mortgage is one of the biggest financial decisions many individuals will make in their lifetime. And as a real estate professional, it's important to be able to assist your client in finding the right mortgage for their situation.